Hello, everybody. I'm Sarah Rosen-Wartell, FHA geek, and also president of the Urban Institute, and really excited to have this event here today with our great partners and friends. I want to thank everybody who's here with us for being in the room and encourage you also to continue the conversation online. If you try to resist your emails, but feel free to use, if you look at the agenda, you can see people's Twitter handles on and be part of an online conversation using the hashtag #LiveAtUrban. Appreciate that. I also want to welcome our virtual audience who are watching over the webcast live stream. If you're tuning into the webcast, you can also submit questions to the conversation by sending emails to events@urban.org at any time during the program, and we'll gather them up. It is a sign of the energy and the depth of the community around this topic, how many people we had sign up today, and the size of the online audience. So we're really excited to have everyone here. I think all of you know that we've been going through a, I don't know,
demonstration of Ustream Producer.
2007. So we really started talking about reform of the federal housing system 17 and a half years ago. Terrifying, although that is no, I'm sorry, bad math. Yes, but more recently, a decade ago. And too often that conversation is about GSE reform, federal housing reform. But those in this room don't need anyone to explain to them that FHA is an integral part of the system that and that the relationship between federal housing reform and FHA and Ginny and the other federal government guaranteed programs are integral, and that you really need to understand one in order to understand the other. So perhaps we are at a moment when federal housing finance reform is going to move forward again. Some of us have been saying that phrase a little more often over the last decade than you would think. But we want to make sure that if that momentum does gather, and whether or not we're at legislation over the next year or not, each iteration of debate and reform refines ideas and builds readiness for the policy debate, shapes the regulatory actions, et cetera. So at the moment which we're having those conversations, it's critically important that we think about FHA and its role in those systems as an integral part of those conversations. So we're really happy to have Carol Galante, who is the director of the Turner Center for Housing Innovation at the University of California, Berkeley, here. Carol is one of the many FHA alums. She served as FHA commissioner. We've got a few others, former and future FHA commissioners here with us in the room. Carol has put together a recent paper with some of her ideas for reform, and she's going to share them with us today to get the conversation started. I also think that we're going to hear a little bit from the co-director of the Urban Institute Housing Finance Center about the work of Urban's Mortgage Finance Servicing Collaborative and their work to try to improve the way the FHA foreclosure and conveyance processes work, and a whole set of policy recommendations to reduce loss severities for FHA, reduce unnecessary costs for servicers, and improve outcomes for borrowers and neighborhoods. Servicing in many ways is one of the things that ultimately ends up affecting access to credit in ways that maybe aren't always as well understood by others outside the conversation, and I think we want to make sure that we're really thinking about that as we think about access to credit issues. So first we're going to hear from Carol, then we're going to hear from Lori, and then we're going to have a panel discussion that's going to come with Ed Golding, who is a fellow here at Urban in the Housing Finance Center, but also a former acting FHA commissioner. We're going to hear from Adolfo Mozol, who is currently senior advisor to the secretary at the Department of Housing and Urban Development, and Adolfo is advising him on housing finance issues and reform, and part of the administration's larger reform conversation. Barry Zegas, who's director of housing policy for the CFA, Consumer Federation of America, and a long participant in these conversations with a focus on access to credit, and Ginger Charles, who's Senior Manager for the Consumer Finance Group at PricewaterhouseCoopers, who's going to moderate our conversation.
This is a demonstration of
I said I was an
Ustream
FHA
producer.
geek. Barry reminded me that the paper I wrote in 2002 on FHA reform, sadly, has a whole set of recommendations that are not very different than some of the ones we're going to talk about today. And while there's been a little bit of movement in those directions, these are not necessarily brand new issues. But there may be a moment when this larger conversation creates a chance for us to move some of these and some of the great new ideas that Carol and Laurie have brought forward, as well as what we hope to hear from all of you. So thank you for being here, and look forward to hearing the conversation. Carol. And are we going to, can you put in an extra row of chairs up front if you need to?
Oops. All right, somebody needs to, there we go. I got it. So it's great to be here, and I want to start by thanking Sarah and the Urban Institute for co-hosting this event with us, and I really am following in her footsteps. When she left FHA, she felt compelled to write a paper about what needed to be done, and I had that same itch, and this seemed like enough distance from my time at FHA and perhaps close enough to a point in time where we might actually be able to see some movement, and I thought it was important to resurface these issues. So thank you for Urban for co-hosting this and adding their intellectual heft to the conversation on FHA, as well as for all the fantastic logistical support to make this happen. I also want to acknowledge, I'm looking around, my co-author on this paper, Nate, where are you? Oh, there you are. Nate Schultz, who worked with me at FHA and is the co-author of this. So any errors are mine, anything smart is his, and we'll take it from there. But I also am really glad that Sarah actually said, look, we're all in this room because we, I believe, care about what the FHA can contribute to society, and we need to really look at how it can deliver that most effectively. And so I do want to...
Demonstration of Ustream producer.
Okay. What? There it is. Okay. I don't know. It seems a little slow. But I do want to start by just framing why I think it is important, why the FHA is important. And this slide just shows a little bit of single-family endorsements since 2000. And you can certainly see the countercyclical impact of the FHA during the recession years and how important that was for people to be able to have access to credit when really the private sector was out of the business for a considerable period of time. Oh, okay. Here we go. All right. So I do want to make one point that doesn't often get made when we talk about FHA, and that is that FHA is not just about single-family homes. It is also about multifamily healthcare facilities. This is a chart of endorsements for the same time period for the multifamily business at FHA, and you can see that during the recession, the multifamily business at FHA also had to expand its capacity significantly under great constraints, and was able to do it, but all of these things happened with a great amount of effort and difficulty. But the multifamily is clearly an important component of the FHA. Now, we all, I think, also know that the reason FHA is so important to the homeownership market is it is very much the starting homeownership, entry-level, first-time home buyer place for people who really are underserved by the private market. And you can see here that the percent of first-time home buyers over time in the past couple of years is something like 82% of the purchase mortgage business. And the purchase mortgage business at FHA is a overwhelmingly large percentage of the actual work that FHA does. So critically important. Also critically important, this is a slide of racial characteristics, white, which is in the orange, Hispanic, which is in the purple blue, and African American, which is in the green. And you can see that the FHA clearly is serving a very broad cross-section of the population, but is particularly important to the African American and Hispanic populations. And this is really an important point to me as we think about moving forward and what kind of access is needed and why. And this is because, again, anybody who has studied the FHA and understands the negative history of redlining and policies where the FHA helped create the American homeownership dream. It helped create the suburbanization of the United States, but African Americans were shut out of that potential opportunity. And so as we go into the next phase of the FHA, we have started to turn that around in the past number of decades, and I think we owe it, the FHA and the government owes it to the people who were left behind when the FHA was so active in the 50s and 60s. And I think actually Lori has a slide on this that I think will illuminate this to some degree. And we need to be sure that that kind of access is available moving forward, because we have a growing need to fill in terms of the demographics here. So yep.
This is a
all right.
demonstration
I
of
got to get better at
Ustream
this little
producer.
clicker here. So we put together a number of principles for the reforms that I'm going to spend just a couple minutes to talk about. And the first, really there are three. And the first is that the FHA should continue to serve the underserved, while serving a broad swath of the population. And I'll talk a little bit more about this because I think that is the most important mission area to define moving forward for FHA. The second is that we need to have an FHA that is available as a counter-cyclical force when times are tough. We saw that before. We know that given all the reforms we're going to do, we're not going to have that situation again, but maybe we'll have another situation. Maybe it'll be a regional situation in terms of a bubble, and you need the FHA to be able to step in when there is not robust private sector participation in the market. And the last, and probably the nearest and dearest to my heart, and the one that gets the least amount of attention, is that we need a structure for this agency that gives it the tools and the budget authority and the resources to really effectively do its job. It has been doing its job with, two hands tied behind the back. And I don't know, frankly, how it's been able to function given the very challenging budgetary situation and structural situation. So we'll talk a little bit more about that. So better targeting for the underserved is, principle one. And the way that we thought about this is rather than tinker with the fundamentals of down payments and credit quality and all of the kind of individual characteristics of borrowers that you could expand or tighten, is to think about those things staying essentially as they are, and you're always going to tinker around the edges, but essentially staying as they are, and ensuring that you have a broad population in terms of credit quality, because FHA, again, under the principles of reform, needs to stay as a average pricer, and is going to have some credits that are better than others. And as an insurance pool, it really needs to have that flexibility. So how do you then ensure that you have an FHA that is serving the underserved and not serving people who could easily be served by the private market? And this is a tricky place to find the balance. And so the ideas that we came up here were, one, lower the loan limits a little bit from 115% to 100 of the median, and cede some of that market to the private sector. And then, at the same time, and this is an important component of the loan limit conversation, really look at targeting smaller population-based geographic loan limits, so that you don't have a situation where in one metro area you've got a market price of $700,000, but the FHA loan limit is 400, and in that same metro area, you have a micro market where the loan limit or the purchase price is $200,000, and you've got a $400,000 loan limit. So you'll have people in that situation actually being able to access homes with the FHA at, quote, above market. So targeting in this day and age with technology, and we're going to help FHA be able to do that, we really need to have a more nuanced look at the micro markets for geography. And I think that will help a lot in terms of targeting. I just want to go back one second. That in terms of targeting the FHA business. And the last, and probably maybe the most controversial, but certainly a very important aspect of targeting, is really having FHA focus on purchase mortgages and refinances of existing FHA borrowers in normal times. So if you went back to that slide on all the business that FHA did during the recession, not a reasonable portion was refinancing people out of PLS because FHA was the only place they could go. And, during stressful times, that is an appropriate role, but it should be a conscious decision to say, we're in a situation here, FHA wants to turn on the ability to do that and not just let it happen all the time in good times and in bad times, but really constrain the product to those people who need it as a first-time home buyer or need to access their equity and they already have an FHA loan. But if you've been able to get a GSE loan, then why do you need to refinance into an FHA? And I think, there we're creating some unnecessary competition between the sectors. So I know you can't read these little boxes, but let me just describe the structural change that we think would be really important to enable FHA to operate effectively. And that is that right now you have the FHA in HUD. We propose that it stay in HUD, but that the FHA get a separate appropriation, congressional appropriation for its budget authority. So it is not competing with HUD. It gets its own, like a bureau within the agency. And that the multifamily FHA programs stay with FHA. And that the subsidy programs for those rental properties, project-based, Section 8, et cetera, go in a new Office of Rental Housing that is combined with other rental subsidy programs, so that the focus of what was the Office of Housing really becomes the FHA, and that FHA Corp or bureau within the agency have its own support system, its own IT, its own procurement. It is half the employees basically at HUD as it is, and it's just important for it to have control over its day-to-day resources, that FHA be able to have a budget situation separate from HUD, its own designated appropriation, and at the same time, it be able to use some of the revenue that it generates through receipts as volume is going up to offset some of its administrative and personnel expenses, which it cannot do today under a variety of requirements. Capital reserve, was a big issue when I was at FHA, and I have evolved my thinking on the situation with reserves probably significantly over time. And I would say this, there is an argument that FHA shouldn't have reserves at all. Most of the credit programs in the United States do not have separate reserves. They have the full faith and credit of the government. You don't need to put aside the reserves in addition. I do think, however, having that requirement does create a discipline within the agency and within the personnel that is quite useful in terms of being sure that people are really tracking the risk profile and the policies and what's happening with the portfolio. And so I do think that if the Congress wants to ensure that FHA can withstand the same kind of crisis that we had in 2008, 2009, then we should absolutely keep a reserve fund, and probably should think about figuring out the best formula for that reserve fund, which at the moment is a bit counterintuitive and doesn't enable you to have reserves on hand or calculate it as volume is going up so quickly, and you've got a denominator problem when you've got the volume going up quickly, and you have losses happening on old books, and you're out of sync. And so thinking about a formula that is more in sync, loan by loan basis, for example, would be a worthwhile endeavor. I would also say on this that there's been a lot of discussion, and I think Lori will touch on this, a lot of discussion about the HECM portfolio and again, how that is accounted for, but it wasn't always in the same fund as the single-family forward mortgages, and it is such a different business. It really obfuscates, for better and for worse, what is going on in each of the funds, and so I would recommend that we separate those capital reserve accounts and look at them separately and judge the portfolios separately. Then just management of operations, and I know this is not the sexy stuff, but this is where the hard, work actually comes together. And one of the reasons I think it's hard to deal with from policy in Congress is it isn't sexy and it doesn't seem to have political implications, and so there isn't like people getting all excited about how to change the budget or how to change the operational aspects of the FHA. But really, it is, I would say, bordering on, criminal isn't the word, but negligence that, the risk management, and I see Frank Vedrano in the back of the room, the risk management function, which did not exist at FHA before we came in as a separate entity, the risk management function and what those folks do and the level of talent and quality of people that you need to perform these functions can go right across the street to the FHFA, to the FDIC, to the credit union, because they're on a higher salary scale than FHA. FHA is on the general salary scale. So I think that is, negligent operation of a $1 trillion insurance company. And for select positions, FHA needs to be able to compete for that same talent with its sister financial agencies. And it can use some other flexibilities, particularly in times of crisis. So we're also proposing emergency power authority when certain triggers happen, and ensure that FHA can say stop a program that is clearly causing losses, even though it's a statutorily required program, temporarily. So let FHA, in times of emergency, make the hard decision, then go to Congress and say, we're taking this action. We either need you to confirm it, or we'll stop in 2 years or 18 months. But that there's a time period under which the FHA can make these decisions on their own. Now, I'm going to conclude here pretty quickly. I think Lori will get into, there are a number of things. Everything I've just talked about requires statutory change. The reason we did this paper was to look at what are the things that really Congress should be taking up when it's looking at how FHA intersects with the new system. There are lots of things that FHA can do administratively to improve its business practices and serve people more. I'm not going to go through these, but I see some of my old friends from FHA here. Some of these things we tried to work on still haven't gotten done, and they just should happen. We're not in a crisis anymore, so let's get on with making these kinds of changes. And then last but not least, I want to conclude on this. If you can really reform the administrative functions of the FHA, I would love to see it go back to its early history, so to speak, where it really was innovating product, where you really could test some pilots. What better place to do this than, with a government agency whose mission is to serve credit access for borrowers in the country, but to experiment with some things that maybe the private sector isn't going to take on all by itself from the get-go, but maybe you could demonstrate some worthy ideas. And I just think there's a number of things I list up here, but I think products like the lease purchase, products like, single-family rental financing, all of these things you could do at a lower cost with more access for lower income people by experimenting with some of these ideas within the FHA. And so I'd love to see FHA go back to some of that history and come up with some great ideas. So with that, I'm going to conclude. turn it over to Lori, and I'll see you on the panel when we're done. Thank you.
It's really an honor to be co-hosting this event with Carol, and her paper was fabulous. We all thoroughly enjoyed reading it, and hopefully my set of comments is going to be followed by a robust discussion. They're adding a set of chairs in the front row, so those of you who are standing, please don't stand, come up and sit. There's lots of room for you. With that, let me kick off my talk. Carol's provided, one other thing is I am just recuperating from the flu, so hopefully I sound better than I feel right now. and hopefully more coherent. This shows you the FHA share of single-family loan originations between 1935 and 2017. The FHA share has averaged 12.8% over the period, and the plus and minus one standard deviation, is about 7%. So you can see that, and we're well within those bands. You can see that FHA has played a very, very important countercyclical role. Its share was very, very low in the 2005, 2006, 2007 period, very high in the 2009, 2010 period. And it's absolutely critical, as Carol mentioned, that FHA continue providing this role. She's provided a robust set of recommendations on overhauling FHA. I'd like to share a few numbers on the FHA we have today, and I'm going to provide a few suggestions to make it better. In particular, removing uncertainty created by the False Claims Act, and secondly, reducing the cost and complexity of servicing troubled loans while creating better outcomes. So this basically is a very, very long-term view of the FHA. The FHA disproportionately serves first-time home buyers. About 82% of FHA's purchase book of business is first-time home buyers, as compared to about 46% for the GSEs. Now, it's very interesting that when you look at the characteristics, and I too am having trouble with this, with the little clicker. FHA borrowers have weaker credit characteristics than GSE borrowers. You can see the first time, if you look at the column comparing first-time FHA borrowers to first-time GSE borrowers, you can see that they have a lower loan balance. You can see they have a much lower credit score, a much higher LTV, a much higher debt-to-income ratio, and a slightly higher loan rate. And that's no surprise to anyone sitting in this room. I thought the more interesting comparison was when you compare GSE repeat home buyers with FHA repeat home buyers. What you find is that GSE repeat home buyers are much, much stronger than their first-time home buying counterparts. By contrast, FHA repeat home buyers are actually not that much stronger than their first-time home buying counterparts. In fact, they look very, very similar. And if you looked at FHA refi loans, which I did not do here, the credit scores on those refi loans are even lower than the credit scores to first-time home buyers or repeat purchase home buyers, although the LTVs are significantly lower. But the point is that FHA borrowers have much, much weaker characteristics in general. As Carol pointed out, FHA disproportionately serves minorities, in particular blacks and Hispanics. The first table is the table that Carol showed. So we're going to focus on the bottom table, which shows that the percent of purchase loans that are FHA insured by race, ethnicity is way, way higher in the black and Hispanic community. 45% of purchase loans to black borrowers are through FHA, 44% to Hispanic borrowers, 23% to all borrowers. So FHA plays an extremely critical role for these communities. This shows it's not surprising given the weaker credit characteristics of FHA loans, that FHA delinquency rates are much higher than their conventional counterparts. This shows you the latest MBA delinquency rate is about 3.86% for FHA loans versus right around 1% for the GSEs. What's really interesting, though, is if you'll notice that FHA delinquency rates are currently well below their 2005-2006 levels. By contrast, GSE delinquency rates are slightly above their 2005-2006 levels. Okay. FHA origination is currently dominated by non-banks, and this is actually a fascinating slide. This shows you that 82% of FHA origination is currently done by non-banks, up from about 38% in 2013. About 73% of VA origination, around 55% for the GSEs. So basically, clearly non-bank origination has increased for everybody, but it has increased much more for FHA and VA origination. And we're going to contend that the False Claims Act and the high cost of servicing delinquent loans play a role in this, particularly the False Claims Act. Why do we worry about the large non-bank share? At some point, we worry about the large non-bank share because it makes the government market more pro-cyclical, expanding when times are good and contracting when they're not. And the second reason why we worry about a non-bank share that's too large is it makes FHA lender oversight much, much more challenging. So it's not that there's a perfect number, but you look at these numbers and you say, well, why are the banks fleeing this market? This shows you that non-bank originators have a much, much wider credit box than their bank counterparts. This shows you that the bank median FICO score is currently around 684 for FHA borrowers. It's 666 for non-banks. So banks 684, non-banks 666, an 18-point differential. And you can see that that differential has actually been growing through time. For those of you that are interested in accessing these numbers on a regular basis, they're in our Ginnie Mae Global Market Analysis Report that is actually on the Ginnie Mae website. So the market share information and the credit box is posted on the Ginnie Mae website. Even though the FHA does not do risk-based pricing, originators do charge more for weaker borrowers. So you can see, according to the latest numbers, that that on average, FHA loans to borrowers with less than a 650 FICO score were about 4.5%. They were about 4% for FICO scores greater than 760. So you basically had a 50 basis point differential for credit quality. And again, these are originator charges. These are not FHA charges because FHA does not do risk-based pricing. 2 steps to strengthen today's FHA. First, remove uncertainty created by the False Claims Act. And second, reduce the costs and complexity of servicing troubled loans. On the False Claims Act, and I think this is the single largest reason why the bank share is down so much, essentially lenders certify that the factual contents of every FHA loan is absolutely correct and they have complied with all FHA rules. If either of these turn out not to have been true, the lender is subject to damages of 3 times the amount of the insurance claim. And this shows you that so far there have been 22 lenders that have settled with the Department of Justice under the False Claims Act, and it shows you the amount of the settlements. 22 lenders, every single one of the largest banks bank lenders is represented here. Citi, Chase, Bank of America, U.S. Bank, and Wells Fargo. So, and there are actually two who currently have litigation in process: Quicken Loans and Guild Mortgage. Essentially, lenders have responded to the False Claims Act, as well as the high cost and complexity of servicing troubled loans, with putting credit overlays on their lending, which is why you see that the bank FICO scores are so much higher than the non-bank FICO scores, because lenders with the deeper pockets respond with more overlays. So how do you deal with this? The short-term way to deal with this is to improve the certification. One way to do that is to impose a materiality threshold. That is, you're only subject to the False Claims Act if, in fact, the error was material, although in practice it's hard to achieve language that is acceptable to both the lenders and the FHA. The better long-term way to deal with this is to fully implement the defect taxonomy, otherwise known as FHA's Single-Family Housing Loan Quality Assessment Methodology. That's a mouthful. Essentially, this is a wonderful piece of work done in 2015. Where basically every defect is classified as to severity from 1 to 4, with 1 being the most severe, things like fraud, and 4 being the least severe, loans that would have been made anyway. You can basically set up a set of rules like only numbers 1 and 2, or number 1 only qualifies for the False Claims Act. The issue is that the defect taxonomy exists only as a PowerPoint presentation on the FHA website. It actually has to be implemented, which requires the improvements in systems that Carol so eloquently spoke about. But certainly removing uncertainties created by the False Claims Act is critically important. Both Ben Carson and Brian Montgomery have vowed to tackle this issue, and we are very, very much looking forward to seeing the results of that. The second set of improvements is reducing the cost and complexity of servicing troubled loans. And Urban Institute has organized a mortgage servicing collaborative. The purpose of the collaborative is to begin the work of developing, analyzing, and making recommendations for reforms that will improve access to credit for consumers and address lender reluctance to originate and service mortgages. We have about 30 members of the collaborative, including national servicers, depositories and non-banks, community banks, credit unions, consumer and civil rights organizations, academics, specialty servicers, sub-servicers, trade associations, and technology providers. The first set of issues tackled by the Mortgage Servicing Collaborative were improvements in FHA servicing and government modifications in a rising rate environment. This shows you the cost of servicing loans, and you can see here that the cost of servicing a non-performing loan is $2,113 a year versus $163 for a performing loan. Since 2008, the cost of servicing a non-performing loan has gone up 2.76 times, while the cost of servicing a performing loan has gone up the cost of servicing a performing loan has gone up 2 3/4 times, while the cost of servicing a non-performing loan has gone up 4.4 times. So it is very, very expensive to service non-performing loans. FHA servicing is still more expensive. Our servicing collaborative members estimate and have provided us numbers that show that FHA non-performing loan servicing is 3 times as expensive as servicing GSE non-performing loans. So a number of recommendations along those lines that will bring down the costs and improve the outcomes. First is unified timelines. FHA currently has 3 timelines, one from first missed payment to legal action date, which is the date foreclosure has to be initiated, a second from legal action date to foreclosure auction date, and a third from auction date to conveyance. And there are interest curtailment penalties from the date of the missed deadline to conveyance that don't reflect the number of days of delay. So if you miss the first legal action date by 1 day, the interest curtailment extends for the rest of the period. There should be one unified timeline, as is the case for VA and GSE loans, which would provide for more flexibility in the loss mitigation process. So if you're in the middle of doing loss mitigation on the first legal action date, you wouldn't have to seek an exception. You could finish doing the loss, you could finish the loss mitigation process. So it would result in a lot more flexibility and better outcomes. A second set of recommendations centers around the FHA conveyance process. The FHA conveyance process does not have a counterpart in any other entity. For both GSE and VA loans, foreclosure is done in the name of the agency. On FHA loans, foreclosure is done in the name of the lender, and the lender then conveys the property to FHA. This process takes a full year according to FHA's own numbers. FHA, and it's very costly to all, including FHA, lenders, and most important of all, communities where you have blighted homes sitting there, and produces suboptimal outcomes. To optimize the outcomes, some properties should be improved before sale, some should not. There's no mechanism in this for differentiating. In the short term, FHA can address the costly conveyance process by increasing the flexibility around conveyance alternatives, such as short sales, third-party sales, and foreclosure sales. In particular, the claim without conveyance of title program could be improved. And in the longer term, we think the conveyance process could be improved by building a direct conveyance capability within HUD or using the GSE REO disposition infrastructure. So there's a number of different alternatives. The final set of recommendations that we actually just came out with today were on dealing with modifications in a rising rate environment. The FHA toolkit for dealing with modifications is much, much more limited than the GSE toolkit. And in a rising rate environment, this is likely to be very, very counterproductive to borrowers. The main way borrowers, the key to a successful modification is payment reduction. In FHA mortgages, there's no mechanism if interest rates you reset the interest rate to a market rate of interest. That is the PMS rate plus 25 basis points. If interest rates have gone down, that works great. The borrower gets the benefit of the lower rate. However, if interest rates have gone up, that works horribly because the borrower is essentially paying a higher rate, so his payments have just gone up. In addition, there's limits to extending the term. You can only re-extend the term to 360 months rather than 480 months in a GSE loan. So our key recommendation is that if interest rates go up, you really want to be able to use the partial claim. You really want to be able to use a partial claim with recast for FHA and USDA mortgages and leave the loan in the pool, so essentially the borrower has the advantage of keeping the lower interest rate. This seems like common sense. If you're doing a modification, you don't want to raise the borrower's interest rate. So we're out with that set of recommendations today. So the introductory paper for the Mortgage Servicing Collaborative and that first set of recommendations is out today. And we look forward to hearing your feedback on it, and we'd like to thank the Mortgage Servicing Collaborative members who have been so generous in their time in talking about these issues as well. So with that, let me turn it over to Ginger to open up the panel.
Hello, everyone. There are still seats up front for those standing. Frank, I'm looking at you, but others as well. So thank you all for being here this afternoon. And thank you to Carol and Lori for the informative presentations. You've certainly given us a lot of food for thought here on for housing industry participants, for lenders, for servicers, for borrowers even, and vendors, as well as for policymakers and legislators about how we should consider thinking about FHA. Conveniently, we're at an inflection point on the topic with reports that the Senate is drafting another proposal on housing finance reform, that the House Financial Services chairman has shown a newfound willingness to consider broader government involvement in a newly calibrated market, and members of the administration are reportedly also engaged in reform dialogue. So with that, and to Sarah Wartel's earlier point, I'd like to spend some time diving a little bit deeper into the views of our panelists here on how one should think about FHA in the context of broader housing finance reform. So to my left here, I have Ed Golding here at Urban, former acting FHA commissioner, Adolfo Morazol, Barry Zegas, and obviously Carol Galante. So with that, Ed, you most recently sat in the front office, if you will. So based on what you've heard today, particularly the Turner Center paper brought to us by Carol and Nate, what do you think about the proposals to improve FHA?
It was a very well drafted set of proposals. I think I just want to go back to one slide that Lori had, which is the role of FHA. And if you look, I like going back a long time in history. It really did average around 13% of market share. And I think it's important to recognize that it's right about at that level today. So as we go into reforming FHA, I want to push back on sort of the undertones that somehow it's an outsized agency right now. It really is pretty much close to its average and clearly within one standard deviation. So I think that's an important part to keep in mind as we try to calibrate loan limits or products. The other thing I'd sort of point out, a lot of GSE reform should naturally increase the GSE market share, whether it's the full faith and credit guarantee, which should improve their security, even the tax code change. Having done this for many years, the reduction in the tax code should reduce, if you're holding 3% capital and you're doing the calculations quickly, should reduce the cost to the consumer by about 8 basis points. Also think the GSEs could become more efficient. So I think you're going to pick up a roughly 20 basis point benefit to the GSEs for GSE reform. That alone should shift a lot of the market share back to them. So we should really be very careful. It was a very well thought out proposal, but I do want to sort of caution people. The aim should not be to reduce FHA's footprint. It's not outsized, and there are some reasons to believe the GSE share will grow over time anyway.
Okay. Carol, do you have any thoughts on Lori's presentation?
I think what I found most interesting, besides those initial slides on history, which were great, is these are all topics, the servicing topics, the lender certification topics that have been under conversation between FHA and lenders for, almost as long as Dave Stevens was there. So maybe not in the very, very beginning of the crisis. We had other things to worry about. But these are topics that have been under conversation for a very long time. And I think a lot of them should happen. But I don't think really most of them will be able to be executed on unless you tackle the other structural reforms that I've proposed, like without the IT systems, without the staffing, salaries, all of those kinds of structural reforms. I think these other things just aren't going to be able to be implemented.
So, Barry, you hear Ed say that GSE reform will naturally just shift volume away from FHA. You hear Carol say there's not that much new under the sun here in terms of these recommendations, so let's move on with this already. What do you think about what you've heard here today and what you've heard in the years that we've been having versions of these conversations about how we should proceed on this topic?
So I'll echo what Ed said about the papers. I think both papers are terrific contributions, and the things that Carol has highlighted in her presentation I think are critical. I would just say, to sort of pick up on Ed's comment, that I think of it as there's an inside game and an outside game. The inside game is, what do you need for FHA to really be a strong, durable, dependable source of credit insurance in any organizational frame? The outside game is, what is the role of FHA in a larger government support, a government model of support for the housing finance system? Nobody assumes that, at least I don't, that the GSE reform is going to lead to Fannie and Freddie, with a 20 basis point benefit on their execution, and a tax benefit. We think of it as really a system that's going to, in fact, rely more heavily on private capital. Private capital has to get paid for the risk it takes. We're all worried about how that functions. And a lot of time and energy goes into thinking about the GSE system as one closed system in which we have to struggle to figure out how to get broad access. And then we kind of have this apostrophe on the side called FHA. And really, as we move to what I think is going to become a unified system, all the proposals suggest that, with one guarantee on the security, to me the more compelling question is, inside game aside, how do we think about the role of FHA? Where do we think the boundaries between some new systems, privately capitalized risk-taking, and the government's support of the market through its risk-taking meet? And I think that's the question that actually keeps getting avoided, if you ask my opinion, because it's not convenient to talk about it in any one of these contexts. So I would frame it that way. I think the paper names the key things that need to be done for FHA's health and safety, but I think we still haven't grappled with what is the role of FHA in the larger housing finance system as we contemplate the kind of reform that's coming.
So I would say, for the people in this room, FHA is fortunately not just an apostrophe. And to the thousands of people who work there.
A liver.
And I would actually take
You're going.
I'll take this opportunity to remind the folks who are watching online to please send in your questions to events@urban.org. And others in the room, please prepare for the Q&A, which will follow our panel. But pivoting to Adolfo, who's living this in real time, can you tell us a bit about what's been going on at FHA over the past few months, and what do you think the views are of the agency, of HUD more broadly, on some of the proposals that we've discussed today?
Great. Well, first of all, thank you, Urban, for having me be part of this, and thank you, Carol, because I do think your paper is awfully comprehensive, raises a lot of very good issues that need to be looked at. We have been very busy at FHA and at Ginnie Mae. I have to say I think we have a terrific mortgage team there. I've got great colleagues. I'm going to put in a shameless plug for the fact that it will be an even better team, an even stronger team when Brian Montgomery is confirmed as FHA Commissioner, and we're doing our darndest to hold the fort down until Brian gets there. So Brian, we're doing our best and looking forward to having you. I thought what might be helpful, if I did for the group, just before the holidays we released the 2017 FHA annual report. I'm not going to reprise the whole report. What I thought I might do for the group is mention a few data points from the report that I think speak to some of the recommendations or some of the issues raised by Carol's paper. One, Carol talks about re-looking at the sufficiency of the 2% capital requirement, and I think it should be not just sort of the sufficiency, but the structure of the capital requirement. I think the report, very much raises that question. First of all, it's a very large book, $1.2 trillion book of insured mortgages. That's about 11% of all the mortgage debt outstanding, single-family mortgage debt. The capital ratio was above 2%, but not a lot. It was 2.09%. We put a fair amount of stress testing in the report, and I think the stress testing, and I think there'll be more of that to come, but it certainly suggests it doesn't take a lot of stress to push the fund below 2%. And in fact, a meaningful stress short of the Great Recession would certainly push it negative. And had we allowed premiums to be reduced in January of 2017, we would have found ourselves under 2% at the end of the fiscal year. So I think Carol is right to put that on the table. And I think a complementary policy question with the capital ratio is, which I think is implicit to your recommendation, but I would make explicit, is how should FHA think about pricing and setting premiums, through the cycle? I think that's something that very much merits some consideration. I think Carol's recommendation around targeting, just a few comments there. I think I feel a little differently than Ed does. If you look at the data, you go back to 2014, FHA's market share was, gradually declining. In early 2015, there was a very large premium reduction implemented by FHA. About half of the total increase that was put in place during the crisis was reversed. And you see the market share springs back. And so what that says to me is there's some reasonable amount of population that can shift between conventional financing where there's private capital and FHA. And I do think that Ed is absolutely right in saying, and Barry is right in saying, we've got to look at, as we do housing finance reform, where is that GSE conventional execution going to come out? And FHA's framework and footprint needs to think about, not just be internally focused, needs to think about what that GSE market is going to end up looking like. I guess the last thing I'll comment on is the report definitely highlights the different fiscal condition between reverse mortgages and forward mortgages. That's quite dramatic. In the report, forward mortgages are in very good fiscal condition, reverse mortgages, not so much. I think it validates that our administration had to make changes last year to the reverse mortgage to try to get new business on a sounder financial footing. And so we're monitoring the results of those changes. But I would just remind folks that those changes, they don't fix the issues related to the outstanding portfolio. And so in the conversation about reverse mortgages, where should it be, let's not lose sight of, I think there's still work to do and work we're trying to do with industry and with advisors on what can be done about that existing portfolio, because we owe that to taxpayers. The Secretary tells us every day that we should work at FHA to fulfill our mission, but to do it with taxpayers in mind and to do it with sustainability in mind. Sustainability for borrowers, sustainability for our program. And that's how we're trying to approach the decisions that we have to make.
Thanks, Adolfo. Ed, do you have any reactions to what Adolfo's had to say regarding setting premiums? And also, most of your tenure was focused on trying to manage a portfolio in light of the impact of HECM. So if you have thoughts on that as well.
Well, the trouble with HECM portfolio is, the important reforms that were recently put in, but even more importantly, I think, Carol, under you, maybe under Dave, but before my time, there were also important reforms with congressional action put in. The trouble with a mortgage that doesn't pay there are no payments on it, you really don't know whether you've made improvements in the program really for 4, 5, 6 years. So that lag structure makes it a very tough portfolio to risk manage. As I look at the numbers, I'm still hopeful by next year you will see delinquencies on the books that were written 4 years ago being much lower. But time will tell on there. That there's that lag structure on HECMs that makes it a very difficult program. Although going back to Carol's point, it is one of the areas where FHA innovated. It's viewed as a pilot still in many ways. It's just a tough pilot to do, but an important one because there isn't private sector alternatives, unfortunately, to that. And for many people, it's such an important program to age in place. So it's that balancing of mission and a very difficult book to risk. I think on pricing on the mortgage portfolio, this is where reasonable people just disagree. I always viewed the charge it's a mutual fund, it's a mutual insurance program. You're supposed to price, as long as you're above 2%, you're supposed to be pricing at the expected losses. on that, as I view it mathematically sort of the same as taxing home ownership, and I didn't see the purpose of doing that. But again, reasonable people may disagree on that one.
So there are many people in this room and watching online who have lived through the trauma of rolling out that annual report, and when that report speaks of when it falls below 2%. And so now we have proposals on the table that suggest maybe raising that as a management tool, if nothing else. Barry, what is your feedback on that, especially as it relates to consumers?
Well, I don't think there's any hard and fast answer. Obviously, I agree with Ed. The FHA is a mortgage insurance program. It should have good actuarials, and it should charge an all-in fee that gives it confidence that, except in the most exigent circumstances, when it can rely on a federal guarantee to back it up, it can pay its bills and make good on its claims. That's a math problem, and so I don't have a specific number. I thought it was interesting in the report, Adolfo referenced that when you do separate the HECM portfolio, the forward mortgage portfolio is well above, it's 50% above the mandated level. I'm in no position to know, is that enough? Is it too much? Is it too little? But I do think it's important going forward, so consumers have access to this form of mortgage insurance, that it be financially sound. And to me, that's what should drive the question of the capital levels. I think to the point that Carol makes in the paper about separating FHA but keeping it within congressional oversight, the administrative structure of HUD with a specific appropriation. She and I disagree on this, and we discussed it during the development of the paper. I'm hewing a little more to what the Millennial Housing Commission report that Sarah worked on recommended, which is a separate corporation. Because I do think one of the things that gets in the way here is Congress is not particularly good at fine-tuning financial ratios and understanding and managing risk. But when they put their foot down and make a decision that's as political as it is economic, it can hamper the ability of an organization to respond to economic circumstance. So I think that's a particular potential drawback in the model Carol has recommended. I think her model is far better than what we have today. But this is a great example of it. If Congress wants to tell FHA to have an X% reserve, they kind of have to have it, whether it turns out to be the right number or not.
So let's play into this potential conflict on the panel here. Carol, why do you think your model is better than we'll call it the Wartell model?
The Wartell model. Yeah. So
The Wartell model.
I would say this. I mean, we looked at this long and hard, and it was, I think you can make the argument it should be a separate, totally separate corporation. The flip side is, and it goes back to why we also tried to, I don't want to say constrain FHA, but try to actually define that appropriate role of FHA in the market. Why should FHA be financing, cash out refis for somebody who doesn't have an FHA loan? Like, what is the public purpose of that under the new system where, if you bought your house and you want to refi and you want to pull some money out, why would you have a full government guarantee to do that refi? Why not stick with this new system? So we tried to pick things that were still very solidly within the mission of an FHA, low wealth borrowers, don't mess with the down payment requirements, don't mess with the credit score requirements, but try to define FHA in relationship to a new system that we don't know, but so the best we could, projecting what that new system looks like. How that is relevant to the structure is we are 20 plus years later, at least, from when Sarah did her paper. We're in a totally different 16. We're in a totally different environment with respect to the GSEs. And my concern would be if you make a proposal to totally take FHA out of HUD and set up a totally separate corporation, it's going to get set up kind of within this new system, and it's basically going to get bled away. It's going to get bled away. I'm confident of that if you try to create a separate system. It's just going to get wrapped into the reform, whatever the reform system looks like. Not 100% guarantee. Not a fully backed government corporation. And that concerns me a lot in terms of its potential mission.
So Ed?
I think keeping it in HUD is important. It is the department that we have for housing, and some of these things just have to be decided based on the politics of it. What do you want the home ownership rate to be, and the like, and what is a moderate income family that needs the extra subsidy? These are things that it's very hard for a corporation to grapple with. They are, in the best sense, political decisions, and I do think keeping that connection with HUD is very important.
So you agree with me?
It's not the first time.
He said, I didn't say that.
How about you, Barry? Did I convince you?
I think there's merit on both sides of this, and the question of how this relates to structure and function relate to what happens with mortgage reform more broadly written, I think is really critical, as I said in my first comment. And this is the tension between the political expectations of what might happen, right? So do you operate out of the fear of political changes that leave FHA not doing what it's supposed to do, or do you try to strive for a well-chartered, well-regulated corporation that does not have this legacy tie to the Congress that I think in many ways can trip it up? And so it's just a balancing the pros and cons. As I said, I think the model that Carol has proposed in the paper is far superior to what we have today, because I think it does try to trim some of those constrictions that we all agree are getting in the way of FHA modernizing and being the aggressive mortgage insurer we'd like it to be.
Can I just get a word in here? I'm going to studiously avoid getting into that debate. I think you've heard the pros and cons. I think what I would say is, though, I think one thing we can all agree on is no matter what reforms happen, we do have to have a strategy for funding the technology needs of FHA, and I want to be, a very strong voice for technology modernization. When I look, I have not been there that long, but I was at Fannie Mae for 10 years. I've been in the private sector for 30 plus years. If in terms of gaps to the capabilities that you'd want to see for a $1.2 trillion book doing $250 billion a year of business, technology, and I would add, and I think it was commented on earlier, risk management and risk analytics. The people we have are good. They're extremely diligent. But when I look at the reporting and the analytics and the modeling capabilities at the disposal of the FHA leadership and HUD leadership, the gap is dramatic to the Fannie Mae I left a long time ago. The gap to the Fannie Mae's and the Freddie Macs of today, or even a very well-run private mortgage insurer, are very substantial. So I would say, whatever road of reform we're on, let's make sure those issues get addressed.
Amen.
Here, here.
So I was going to ask, do the rest of the panelists agree, presuming the outcome? So I think we have consensus on that. So Adolfo, I'd say my sense is one of the things that folks react to when it relates to FHA most viscerally, which actually I think gets to the technology challenges that FHA has, is enforcement. And without getting probably into my own views of that, we do know that there have been news reports. Secretary Carson has said that he's in dialogue with the Department of Justice. And so can you give us a sense of, one, like can you share with the audience kind of what does it mean for FHA to do enforcement? Like, who are the players? But also, what is the perspective of the agency with regard to changing how we treat the False Claims Act and other FHA enforcement?
Let me try to answer the question just taking a step back on a couple big picture things. One is we've seen the data that was shared earlier with the group at the way the lender mix at FHA has changed very fundamentally, and that largely banks have voted with their feet and they've left the program. And that absolutely concerns us from a perspective of borrower access and having as robust a borrower access in the marketplaces as we can have. In addition, folks will remember that last year the president, by executive order, told almost all agencies to take a really close look at, costly, needless, duplicative regulation. And HUD was one of the first to respond to that and put out for public comment, seeking feedback on where are those regulatory issues. And we got an earful. We heard a tremendous amount from industry on the whole gamut, and I think that Lori spoke about, from certification through loss mitigation all the way back through conveyance. So I think Lori gave you, a pretty comprehensive look at that and the work that the Urban Institute is doing there. We heard it directly from the lender community and from, the industry trade associations that represent the lender community. We believe in improving all of that, and Secretary Carson has been very clear. He does not want lenders afraid to use FHA because of the fear that a foot fault is going to lead to a very large cost and penalty that's out of proportion to the mistake made. I've been in the mortgage business for 30 years. You cannot achieve perfection in mortgage origination. You cannot achieve perfection in servicing. And it's unfair to ask borrowers to pay for the cost of perfection, because believe me, that cost will be borne by borrowers in the marketplace and by having a smaller mortgage market. So I think our intent here and our aspirations are very positive. I'll go back to my shameless plug. I think these are definitely issues where the leadership of an FHA commissioner would be invaluable. I believe these are issues where technology would be, and the ability to make investment in technology would be extraordinarily helpful. And I think we've got a fair amount. We can make a significant amount of progress on this at HUD and at FHA over the coming months. And I think from there, when we've made that progress, I'm very confident that we'll be able to have very good dialogue with the whole enforcement community within the government, so that lenders don't shy away from doing business with FHA and serving FHA borrowers for reasons that don't make sense.
So I'm going to pivot to Barry here in a second, but before I do that, I do want to remind the audience that we are going to do a Q&A. We're going to get to that very shortly. And those online, again, it's events@urban.org. So Barry, what is your view of this enforcement regime, and would reform of that regime really be to the betterment of consumers, or does it actually risk being a harm?
Well, I'll pause first by saying Helen Konofsky is sitting here, and I'm sure if you wanted a lurid account of what it's like to be in the middle of the gears of federal enforcement, she could take the rest of our time, and I salute her for having had the fortitude to stay as long as she did. I think getting this right is very important to consumers. I don't think you can have something as important as FHA mortgage insurance, which I view as a critical part of mortgage access, particularly for low wealth borrowers, as all these slides have said, if lenders won't depend on it and lenders won't fully use its flexibilities. Having a policy that proclaims a desire to give access on a set of terms, but because of these problems, lenders won't take advantage of them and make them available to consumers, is sort of cutting off your nose to spite your face, or cutting out your apostrophe to save your plurals. I don't know. Something like that. But seriously, I think it is the number one problem, and we've been in to see FHA before about this. And the GSE changes on rep and warrant process, sort of to me illustrate, to Adolfo's point, what organizations that are fully technology enabled have the ability to move quickly. Their day one certainty program at Fannie Mae, their attempt to create the credit quality control, all the QC at the front end, so there isn't this gotcha at the end, you're not arguing over something that happened 6 or 18 months ago, was really designed to provide that path to certainty. And based on what I've heard from lenders, and there are many of them here in the room today, that's working far, far better than it used to. FHA is not there, and to the degree that lenders, reputable lenders with reputation risk and capital risk, are not willing to go to the boundaries of the program and instead have lenders who maybe aren't as well prepared in a stress scenario to step up to their obligations, is not a recipe for success for consumers. So I'm very much in favor of those, Jan. I think they are job number one for FHA right now.
So we are already starting to get some questions. So I'm going to ask the panelists one final question before we get to the audience. So, we have, I'm sure that we have viewers here sitting in the Rayburn or the Ford office building or Dirksen. What is your feedback to them about whether or not inclusion of an FHA title in broader housing finance reform is a nice to have, it'd be convenient, it's timely, or a necessity? And I'll just roll down the panel, and Adolfo can feel free to skip if he needs to do that.
The technology and increased money for technology and staffing is an imperative. I would be cautious about trying to overdefine the FHA boundary with GSEs. Get the GSE model, the conforming model right, let it play out, and then see what additional changes need to be made for FHA. It's a program that's over 80 years old, and it's been very successful in providing that first-time home buyer for lots of generations, not just countercyclically. If you look at the numbers, the 1950s, that was how home ownership grew.
I won't skip. I think I would say that with a $1.2 trillion FHA and a $1.8 or maybe now $1.9 trillion Ginnie Mae, it's difficult for me to conceive that you can have a robust discussion and resolution of the significant questions there are around how our housing finance system is going to work and leave that FHA and Ginnie Mae out of that conversation. So whether that must or must not be a title in the bill, I don't know, but I think it's a very incomplete conversation without inclusion of this very large, government-backed sector of the marketplace.
And I would agree with that. I would say I'm not sure being included in comprehensive legislation is a necessity for FHA, but I think successful prosecution of reform of the secondary market post Fannie Freddie, it is essential to understand and have a theory of change, if you will, about FHA's role. And I happen to think FHA actually is a potential key to solving one of the most vexing issues in GSE reform, which is how do you ensure broad access and affordable access in a system that's going to be relying more heavily in every single model we've seen on private finance, which requires returns to investors that are above what the system has traditionally required. And so whether it's a title in the bill or not, having a clear sense of how we think the system with privately financed credit risk in a new system is going to mesh with and interact with FHA when there's one single federal guarantee for securities, which is a huge change. And we think of these two as being in two separate boxes, and the choice of mortgage insurance determines your securities execution. In a sense, that will not be true under any of the models that are being actively discussed. We'll have one securities execution and a range of mortgage insurance options to stand in front of the government. And if we haven't thought through how those pieces should fit together across the spectrum of things that FHA does best, which, as we've seen, first-time home buyers, low-wealth borrowers, and how that relates to the way we think about the capital structure and charges in the new GSE model, I think we'll be missing a gigantic piece of the puzzle, and we'll spend years trying to catch up to fix it. So I think it's very, very important, at least to structurally and conceptually, have a way of thinking about it and talking about it.
Carol?
I think that was eloquent. I mean, look, I did this paper because I think if there's going to be GSE reform, absolutely these structural issues, it's now, or how likely is it that we'll ever tackle those structural issues at some future point in time? How often does tax reform come around? How often does a housing finance reform opportunity come around? So if we're fixing the system, at a minimum, we need to deal with these administrative structural issues. I also think there is a huge opportunity. So maybe it's a nice to have to figure out the intersection of the new systems now, but I would be following that really closely, the evolution of the new system, and really be focused on the opportunities for ensuring that we have a complementary system and not a system that is disconnected or so competitive that it damages the entirety of the system. and that could happen if we're not careful.
Okay, so we're going to pivot to Q&A. I'm going to go with this online question first, but if folks who want to ask questions can start getting ready and raising your hands, then we'll get to the audience. So this, Carol, I actually think this one should go to you. Please discuss the benefit of housing counseling in improving outcomes for home buyers, regardless of the type of mortgage, and your thoughts on how home buyer involvement with pre-purchase counseling I think they meant to say mitigates risk.
So look, I think financial counseling, housing counseling should really be embedded into the system, whether it's FHA or other loans. I think all the evidence shows that people who have that kind of counseling, both before they take on a mortgage and have an opportunity if they're getting in trouble to have additional counseling at the end of the day, it makes a huge difference. And so, I'm very supportive of that.
I think I'd heard you had actually proposed something along those lines.
Yes, we proposed something along those lines when we were there.
And it's just worth saying, FHA has succeeded in putting together a frame around certification that I think is a very important contribution to that field, because one of the issues that surrounded housing counseling in the past has been uncertainty about, who does what and, how do you figure out it's right. And I think HUD's made great strides, and FHA has been a leader on this, first with Hawk, but then subsequently. And I think that's been an important step forward, and totally agree that that kind of upfront preparation and counseling can really improve performance and improve people's access to credit, and sometimes help dissuade people from taking on a mortgage they shouldn't try to take on.
Thank you. Okay, yeah.
Hello, Jim Carr, Wayne State. Jim Carr, Wayne State University. I want to pick up on something that Barry said, not the part about housing, hiding the apostrophe and something about the plurals. The conversation is really on the future of housing. And I want to congratulate Carol on the paper. I think they are reforms that we should have done long ago, as well as many of those that Sarah had proposed even much, much earlier, a decade ago. Having said that, it seems to me the issues around housing, though, so many of them, and to my view, that are really important are not being discussed at all, not in the context of the conventional market, Fannie and Freddie, or FHA. So I have a question, and that is, one of the things we know we have, right? We can't reform the system until we decide what are the problems. We have an enormous rental affordability problem. We have a lack of supply on single-family housing that's developed. And the question is there a bigger role for FHA to play in the actual production of housing, which is in fact what its original mission was, the creation of suburban America, but we seem to have lost sight of that. The second part of that is that America's cities are revitalizing. Everyone's celebrating the Renaissance. Right here in Washington, D.C., every quadrant of D.C. is renovating, but according to the Urban Institute's own research, the racial wealth gap in D.C. makes the national wealth gap pale by comparison. More than 80-1 is the racial wealth gap here, and largely because of inaccessibility of housing. And now that the development is coming to the very neighborhoods that have struggled for decades, those people are being forced out due to rent increases rather than being anchored. So does FHA have a role to play in these important challenges? And in fact, even on the student loan side, I was glad to see the paper included a conversation around innovative products, but I didn't see anything about shared equity, in which you actually lower the cost of housing as opposed to lower down payments that just increase the debt, or something like a student loan mortgage. So the question is, does FHA play a role in these larger, more compelling, bigger crises in the housing market? And if not, shouldn't we as policymakers, when we're on Capitol Hill, concede that FHA plays a really important but a relatively narrow band? At least that's how it's being played. It doesn't have to play that narrow band. It can play in every one of those fields.
Thoughts?
So part of the reason I was so conscientious about putting in that innovation slide and a paragraph in the paper is I think there is so much more that an FHA can do on both the rental side. And again, there's been some experimentation, but we have to have an agency that can actually deliver on those things. And so we have to walk we're crawling right now. We've got to walk before we tackle those things. And I think, unfortunately, the problem continues to get worse on the production side, on the rental housing side, without these kinds of tools. But the agency really isn't in a position to take on some of those most innovative things. Now, some of them they can. I mean, I did a paper on lease purchase separate from this one. I think I mentioned shared equity product in the paper. So I'm with you on that. And if I can say one other thing, I know we're going to run out of time, but on the production side, on the suburbanization, if you haven't read, I'm sure you have, if you haven't read The Color of Law, which came out this summer by a colleague of mine about, how FHA did promote suburbanization in this country in a very racially segregated way, it's like a must read for anybody in the mortgage industry.
I think we only have time for one more question. Do I have any takers in the room?
Somebody
I think
behind
I see
you there.
back here.
Antoine Thompson, National Association of Real Estate Brokers. I just had a quick question for the panel. Given that this year is the 50th anniversary of the Fair Housing Law, and we are talking about FHA and its historic role in discrimination, if there's one thing that you think that FHA should be doing to increase black home ownership, what would that be, given the conversation at hand? Thank you.
Well, at the risk of starting a controversy, I would say one thing I hope HUD would do is reverse its decision to roll back the affirmatively furthering fair housing requirements, because I think those were a positive step forward in trying to force local governments to confront some of their own behaviors, some of the ways their policies either encourage or don't reduce segregation, residential segregation, and that's well within the department's authority. Sadly, I think they made a decision recently which I think is a step back on that. So that's just a quick answer to that question.
I guess I would say from an opportunity perspective, we think there's a real opportunity to better serve the condo market at FHA. That effort was started by the prior administration. It's being carried forward by our administration. There's still some work to do there, but I think condos are an opportunity area generally for first-time home buyers, and hopefully including African Americans and Hispanics. So more to come, but I think that segment of the market is one that FHA could definitely be doing a better job in.
I might add, I mean, you don't do it with one lever. You do it sort of 50,000 homeowners at a time and figure out the buckets. I think condos are clearly 2 or 3 buckets right there. Down payment assistance needs to be revitalized. That's also hooked up with counseling, but an important part, and the partnership with HFAs are an important aspect. Urban's done some work on that recently. Alternative forms of credit, how we measure income. There's a variety of issues that affect, I think, a lot of these what we can call underserved communities, and you just have to tackle them. Innovation's important on that, but it's not one size fits all. Limited English proficiency may also be a barrier to homeownership in some communities. Asians and Hispanics probably more so than African Americans. But this is where you need a very energetic HUD and FHA to sort of tackle these different parts and figure out how to make progress.
Unfortunately, we are out of time, but I thank you all for being here today. And I would say one last thing, thank you to all of you for being here today and for wanting to be a part of this conversation. And I think I can speak for the panel when I say thank you to those who have been within the walls of HUD and FHA, who are continuing the dialogue, and those who are still there now. Thank you for the work that you're doing.
And thank you, Ginger,
for your moderation.